Hello students, today I would like to welcome you all to this video. In this video, I am going to solve a topical question from the topic depreciation. So this question that I am going to solve in front of you is from the October-November 2020 paper, variant 23 and question number 1. So it says that Saria is preparing the financial statement for the year ended 30th September 2020 and she provided the following information for fixtures and fittings. So the 1st October 2019, which means the opening balances of fixture and fitting at cost and the provision for depreciation of fixture and fitting opening balance. On 31st of January means October, November, December, January, after 4 months, sold fixture and receive a check. So one of the fixture sold and receive a check amounting 1150, and the fixture had been purchased on 1st February 2018 for 1500. So the 1st February we purchased this fixture and fitting and we sold on 31st of January 2020. March 31st, purchase new fixture paying by check 3500. So Saria's policy to provide the depreciation on fixture and fitting at 10% per annum using reducing balance method. A full year depreciation is charged in the year of purchase but none in the year of disposal. So in this question, what is required? We need to prepare the fixture and fitting account and we need to prepare the provision for depreciation of fixture and fitting account and we need to make disposal account. So let's start making the fixture and fitting account. As we know that from the previous video, we know that the fixture and fitting account, it means the cost account. So all the transactions that we record here with the value of cost. So we start with the fixture and fitting opening value, the opening balance, because it's our assets. So assets opening balance comes on debit side. So the opening balance is 28,600 will come up here with the balance BD and the date will be 1st of October 2019. So after this, I always tell my student, after this we need to record the disposal entry first, and that asset that we are going to dispose of, we will write down the value, cost value, the value that we will record here. On the credit side, the cost of the asset that we dispose of is 1500 and it will goes to the disposal account because we dispose this asset. So all the assets that we sold, we transfer those assets to the disposal account and the date will be 31st of January 2020. So the next transaction that we need to record here in this T account, fixture and fitting account, is the purchase asset. So the purchase asset is by check, so it will going to increase our assets, means the debit side. I will record with this entry with the bank account because we made the payment by check. So the cost was 3500 and the date was 31st of March 2020. So these are the main transactions that we are going to record here, and then we'll make the balance of this account. There is no other transaction that will come up here. This side has a bigger value, so 001 and then 2 and then 3. So 32,100 will come up here and we will deduct this 1500. Let me do it here for you guys. 28,600 plus 3,500, 32,100, and then I'm going to deduct 1500 from this value to get the balance. CD figure is 30,600. So that will be with the balance carried down and the balance brought down figure. So it will come up here, balance as brought down 30,600. So the transactions, the dates that we are going to write down is the year end date, and the year end date is 30th September 2020. So I will write down here 30th September, and the next year opening date will be 1st of October 2020. So this will be the account for the fixture and fitting account. The next requirement is we need to prepare the provision for depreciation account. So let me make this on this page. So now we need all this information again. So let me write down here provision for depreciation account of fixture and fitting. So the opening balance of provision for depreciation, it always comes on credit side. So balance brought down is 6185. That will come up here, and the date will be the 1st of October 2019. That will come up here. So after writing down this balance, I always tell my student to calculate the depreciation of the asset we sold. So let's do the working. So for the working, I'm going to use this page. So it says that the dates are very much important, as it says that we purchased this asset on 1st February 2018. So the disposal depreciation working, you guys can do this depreciation working on, you know, the exam sheet or any extra piece of paper. So some of you know, the exams, we got some space available for the working, so we can use that particular space. So let me do it here. The disposal depreciation, so we purchased this asset on 1st of February. So I'm going to write down 1st February 2019. From this date, our year end comes on 30th of September. So 30th of September 2019, that will be our year one, year end. So the policy says that we provide the depreciation 10% per annum using reducing balance method, and full year depreciation charge in the year of purchase but not in the year of disposal. So in this year, year one, doesn't matter that we are going to calculate the depreciation using reducing balance method or with the straight line method. In the first year, we always go with cost, and that was 1500, and it says here, so into the relevant percentage, and that is 10%. And because it's full year depreciation, so we don't need to go with, you know, 5 by 12, 6 by 12 or any other you know, months by months basis. So we are not going to go with months and months basis. So this will be 10% of 1500 is 150. So that's the depreciation for year one. And if we will move on to the next year, it will start from, you know, the 1st of October 2019, and we sold this asset at 31st of January 2020. So the asset that we will sold, here I made some mistakes, so it's 2018. So if it's 2018, so it will 30th of September 2018, that will be year one. So 1st October 2018, and that will end up in 30th of September 2019. So that will be the next year. So that's the year two. So always be very careful with the dates. So that's year two, because it's a reducing balance method. As we know, in the reducing balance method, we will reduce the cost with the previous depreciation, and the previous depreciation was 150. So now the net book value will be 1350, and then we will take 10%. So here we have 1500 less 150, that gives us 1350, and I will take 10% of this value, that will give me 135. So year 2 depreciation will be 135, and after this in year 3 we sold this asset. So that year will start from 1st October 2019, and on 31st of January 2020 we sold this asset, because before the year end of, because this year ends on 30th of September 2020, so before the year end we sold this asset, and the policy is no depreciation in the year of disposal, which means there will be no depreciation. So the total depreciation that we charge against this asset in previous year is 285. That will be the total depreciation of disposal. This figure will write down here in the T account. So in this account, depreciation opening balance comes on credit side, and the value 285 that we have calculated will goes to the disposal account. That will comes up on a debit side, because we have to take out this depreciation from this opening balance, and we have to transfer this depreciation to the disposal account. That will goes on the same again, the disposal date 31st of January 2020. Now the next thing is we need to calculate the remaining assets depreciation. So for that remaining asset depreciation, I'm again going to calculate on a piece of paper. So that will be the depreciation we usually call the current year depreciation. So in this method, the reducing balance method, first of all, what do we have to do? We have to see that how much assets that we have here with us at the year end. So we got the opening balance of cost, and we got the opening balance of depreciation. To deduct that from the cost, so we can get the net book value. Because we are using the reducing balance method, so we need the net book value to apply this percentage 10% to get the calculation of, to get the figure of over depreciation. So the cost of opening that we had is 28,600 is written here, and we have opening 6185 amount of depreciation, which gives me the opening net book value of 28,600 less 6185, 22,415. And now I have sold an asset. So the asset cost was 35, the asset cost was 1500. So 1500 I have to deduct from the cost, and the depreciation of that asset was 285, that I have to deduct from the depreciation figure. After deducting these numbers, I got the cost of the remaining previous year assets, and which was 27,100, and this was 5,900. So 6185 less 285, which gives me 5,900. And now after that, I have purchased a new asset, that's the fixture, at a cost of 3,500. So 3,500 I will add up into the cost. As there is no previous depreciation of this asset, so I have to nothing add here in my depreciation asset, or nothing to deduct. So now the total assets that I have, including the previous and the new assets, so that gives me the total of 630,600. And the value of the depreciation that I have to deduct to get the net book value is 5,900. So 30,600 less 5,900 which gives me the net book value of 24,700. This figure I will use to calculate the depreciation, and now the 10% of this value will gives me the depreciation of current year, and that will be 2470. Another way to calculate this, we can apply this percentage here on this figure, because this will be the old remaining assets that we have, and this was the new asset that we have. So we can calculate separately. If we can calculate this separately here, so the old one will gives me 27,100 cost and 5,900 depreciation value. So I will get 27,100 less 5,900, which gives me 21,200 net book value of old assets. So now I will apply this 10% to get the depreciation of old assets. That will be $2120. And the new asset I can calculate separately. It's 3,500, as there is nothing to deduct because it's a first year one. So I can straight away apply 10% on cost, which gives me 350 of this new asset depreciation, and gives me the total value of depreciation again 2470. That will be the current year depreciation. So you guys can calculate either separately the old remaining assets and the new assets, and or you guys can add up into the cost the new assets. So you guys can do this way. There is another thing that can come up if we are going to calculate depreciation month by month basis. So the months that we use the sold asset, the asset that we sold, we use some of its period here. Like in this example, our year starts from 1st of October and we sold this on 1st of January. So October, November, December and January, 4 months. So we give this 4-month depreciation to here as well in the current year. So now 2470 is the current year depreciation. So here in this account we will write down 2470 on a credit side, and we will mention this with the income statement because this figure will goes to the income statement. So the year end date was 30th of September 2020. We'll write down here, and now we need to close this T account. So the main calculation of the depreciation questions come here, either in this current year depreciation value and in the disposal value. So if you guys have done this correctly, so the question will be easy for you guys. So 6185 is the opening balance plus 2470 is the income statement balance, which gives me 8655. So I'll write down here 8655, 8655, and then I will deduct 285 from this to get the balance carried down figure 8370. So 8370 will come up here as balance CD, and then balance BD here 8370. I always tell my student, do not forget to write down balance brought down because it gives a marks. So 30th September 2020, that's year end date. So 1st of October 2020, that's the next year opening date. So the next requirement is we need to make disposal account. So the disposal account is easy. So the first thing that we need is we need to get this figure from the asset account, because asset account is going to be credited, so it's going to be debited here in the disposal account with the value of asset cost. So I will write down here fixture and fitting, and that was sold on 31st of January, so I will write down here 31st Jan 2020, and the cost of this asset was 1500. The second figure, that is the provision for depreciation account. So provision for depreciation account is going to be debited, so it comes up here on the credit side here. So provision for depreciation is 285, so I'll write down 285 here. So it's again on 31st of January 2020. Now from the question I need another figure. If you guys notice that I have utilized all of the figures except the figure here, we got 1150, and we sold this asset and we got a check 1150. This figure I have not used yet, so I will write down here. So the double entry of this figure will be bank debit and disposal credit, so it will come up here on the credit side 1150 with the bank, because it's a check. Again the same date that will come up here, so 31st of January. Now I have to balance this off to see if we make a profit or we make a loss. If the income statement comes on credit side, which means we make a loss, and if it comes on debit side, which means we make a profit. So this side has a bigger value because this side. So I will deduct this amount from this side to get the value of income statement. So 1500 less 285 less 1150, which gives me the value of 65, and that's the value of loss, the balancing figure, and that will goes to the income statement. On year end, that will be 30th of September. Do not balance carried down, write balance carried down or balance brought down into this account, disposal account, because it's a profit or loss account. So that's how we solve a depreciation question along with the disposal account and cost account. And the second question that I'm going to solve in front of you guys is from October-November 2021, variant 23, question number 2. So it says that Jess, he has the opening balances like on financial position at 31st December 2019, which means the opening balances of cost, accumulated depreciation, and the net book value. So during the year ended 31st December 2020, the following transaction took place on 1st January 2020, means the very next day, 1st January 2020, fixture of 330,000 were purchased by check. On 30th June 2020, the fixture, mean after the 6 month, the fixture was sold for 6,000, which was received by check, and these fixtures had originally been purchased on 1st January 2018. So 1st January 2018 and then 31st of December 2018 will be the year 1, 31st of December 2019 will be the year 2, and this will be the year 3, means 2.5 years we use this asset. And just appreciate fixture on a straight line method, she assumed the fixture will have a useful life of 4 years, at which time the residual value will be 10% of the original cost. The depreciation is charged for each part of the year for which the fixture are owned, which means month by month basis. And what do we have to do? We have to make the fixture account, and we have to make provision for depreciation account and disposal account as well. So let's start with the fixture account. So as we know, the fixture account, we always start with the opening balance, and in the answer it is already written on the debit side. And the next transaction that we need to make is the sold asset. We did purchase, yes, we did purchase on the 1st January, so I will make this transaction first, and I will write down here 1st of January. Again the same year 2020, and we purchased and we paid by check. So the bank will come up here and the amount will be 30,000. That will come up here. And now the next transaction, that the asset that we sold is the cost of that asset was 20,000, because it's a cost account, so we record here. So that will come up here with the disposal account. So 20,000 is the value, is the cost value of the asset that we sold. Always remember, do not write down this value, because this the amount that we receive after selling this asset. So we always record the cost value here. So that was sold on 30th of June. So I'll write down here 30th of June 2020. These three transactions, the only three transactions that I will write down here. And the next step is to balance off this T account. So this side has a bigger value, so debit side is the bigger value, so I will write down here. So that will be 145,000, and 145,000 will come up here. So I will deduct 20,000, which gives me 125,000, and that will be my balance carried down and balance brought down 125,000. So the year end date was 31st of December 2020, and this will be the 1st of January 2021. So these are the transactions that will make in the cost account. So the next account that we need to make, if you guys have noticed, I did not use any of accounting policy terms here while making the fixed T account of fixture cost account. So we don't need those the depreciation figure in that account, so that's why I did not use that. But in this account we need the policy and all those transactions. Similarly, with the fixture account, we already have the opening balance of provision for depreciation, and the next step that we need to calculate the disposal value here, that will write down the depreciation of the assets sold. So in the question, I will make the working here on the separate page. Now we need the policy here, and the policy says, let me write down here, that will be the disposal depreciation working. All right, so in the questions it says that the policy is to calculate depreciation with the straight line method, and the formula is we have a useful life of 4 years of each asset, and we have a 10% of original cost as a residual value. Now focus on the asset that we sold. It was purchased on 1st January 2018 with the cost of 20,000. So as a formula says, 20,000 and 10% of 20,000 is residual value. So 10% of 20,000 will be 2,000. I will do the calculation for you guys. So 2,000. So the formula is cost less residual value divided by useful life, and that is 4 years. So which means 18,000 divided by 4, which gives me the value of depreciation is 4,500. So 4,500 is the depreciation of this asset of each year. So as we purchase this asset on 1st of January 2018, so the year 1 will be starting from 1st January 2018 till 31st of December 2018. I have seen some students, they got confused because they write down here 1st January 2018 and write down 31st of December 2019. So be very careful with the dates while solving depreciation questions. So year 1, as we know, the straight line method will gives you the same value of depreciation each year, so 4,500. And in the second year, year 2 will be the 1st of January 2019 and 31st of December 2019. again gives you the same value of depreciation 4500, and in year 3 is the year in which we sold this asset, and we sold this asset on 30th June 2020, which means it starts from 1st January 2020 till 30th of June 2020. And because our policy is to calculate the depreciation month by month basis, so 4500 multiplied by 6 divided by 12, which means the half of the depreciation, and that gives me, let me do for you guys, multiply by 6 divided by 12, 2250. So 2250. So the total depreciation that we have, because it's a working, so do not add this one here. So the total depreciation of this asset is 9000 plus 2250. So I'm going to write down plus 9000. So previous depreciation was 4500, which gives me 9000, and 2250, which gives me the total of 11250, and that will be the total depreciation of disposal asset, the asset that we dispose of. So we'll write down this figure here in the debit side of this provision and fixture account. So 11250 with the disposal account, and that will be on 30th of June 2020 is the date on which we sold this asset. Now the next figure that I need to calculate is the figure that will be the current year depreciation with the income statement, and that will be on 31st of December 2020. So let's start working for this income statement figure. So again here I comes on the working paper. So the current year depreciation, again I'm going to do the same working as, because right now we are using the straight line method, so I don't need the net book value. So I'm going to focus on cost of the opening balance of my assets. So I had 5000, so I will write down here opening value of the cost was 115,000. So I have sold one asset and the cost of that asset was 20,000. So I will deduct this 20,000 from here. You know, that's the sold asset, and now I left the old asset that I have got is 95,000, the cost value. So that's the old remaining assets. So I'm going to calculate this old remaining calculation, the depreciation value, and that will be, again I'm going to use the same formula as, because it's the policy. So I will deduct the 10% of this 9,500, which gives me 9,500, and then I will divide this by the 4 years, because the policy is same for all the fixture. So I will write down this one, 95,000 must less 9,500 divided by 4, which gives me 21,375. So 21,375 is the depreciation of, you know, the old assets. Now one by one I have you know, this sold asset, and I have used this for 6 months. So 6 months I will you know, calculate the depreciation for 6 months. So 20,000 was the cost less 2,000 divided by 4, which gives me 4,500 as I have calculated here on top. So it will be the same figure multiplied by 6 by 12, which gives me the value of 2250, because that's the current year depreciation in the same year. 1st of January 2020 and 30th June 2020 is the year that we are calculating the depreciation. Now one more asset that we newly purchased, and the cost of that asset was 30,000, and we purchased on 1st of January, which means we will give the whole year depreciation. So if we have a 30,000 here, the working for the new asset purchased, so 30,000 less again 10% of the cost value and divided by useful life of the asset, which means 30 less 3,000, 27,000 divided by 4, which gives me 6750. So 6750 is the depreciation of the new asset. So the total depreciation, I have to add 1, 2 and 3 figures to get the total current year depreciation. So the old one was 21,375 plus 2250 is the sold one, the current year depreciation, and the last one is 6750 is the new asset depreciation. So 30,375, that will be the total depreciation that we will charge into the income statement figure. So 30375 will come up here. That's how we calculate the current year depreciation. Now the balance of this T account, so we have this side obviously always a bigger value, so 77625, I will add this up into the income statement value, which gives me 108,000. So I will write down 108,000 and I will transfer 108,000 to other side, and then I will deduct 11,250, so less 11,250, which gives me 96,750. So 96,750 is the amount that will be my balance carried down and balance brought down figure. 96,750. 1st of January 2021 and 31st of December 2020. So that will be the dates. So the next account that we need to make is the disposal account. Let me make this account here down there. So as we know that the disposal account we make here in the first, we make here on a credit side in the asset account, so 20,000 the cost of that, so that will come up here in the debit side. So disposal account here with the fixture account 20,000, and that's the cost value, and the second value will be the disposal value that we have write down here 11250. that will be from the provision for depreciation account. Now the next figure that we need is how much we got after selling this asset. So we have got 6,000 by check after selling this asset, so that will figure up, that will be, you know, the figure that will come up here. So we have 6,000 because of check. So that's the three figures that we need, and then we'll balance this T account to see if we got profit or loss. Again, this side has a bigger value, which means we make a loss, so 20,000 will come up here, 20,000 will come up here, and the difference will be 20,000 less 11,250 less 6,000, so which gives me the value of 2750. So 2750 will goes to the income statement as an expense because it's our loss. So that's the second question that I've solved in front of you guys. So if there is any other problem that you face while solving the depreciation question, please do write in the comment box, so I will come back to you with the solution. So thank you very much.